Well, welcome again to the Coffee Talk. I'm here with Marcus Fleming from Redfin, and I'm Justin Tenyus with People's Mortgage. We're here at the coffee shop. It's located on Ray and Higley, just west of Higley. Great setting, great location. So if you haven't tried it yet, come on down, have a cup of coffee, and enjoy the scenery. Today we're here to talk about mortgage rates. The news has been increasing rates over the last couple of days, so we'll talk just a little bit about the details and why rates are moving, and is it something to be concerned about if you're in the market, or is it just a little blip on the map?
All right, thanks, Justin. If anybody hasn't tried the pastries down here, the breakfast pastries and the breakfast meals and the specials on the weekends are amazing. Very good food. Nothing worth trying out. And there's also Joe's Barbecue next door if you ever want, or Joe's Farm and Grill next door if you ever want to check that out. So let's talk about the interest rates. Been hearing about it going up and up slowly. I mean, it actually seems like it's a little dramatic. Rates been dropping for last year, 2 years, and now they're kind of going up and people are freaking out. What are your thoughts on it? I mean, we're going from 4% to what, 4.5%?
Not quite that drastic. Not quite that drastic. A lot of rates has to do with trends. Over the last couple months, the rates have been trending downwards, and I would say that we kind of hit the bottom of that trend, and we were kind of watching for what the Fed was going to do. You may have heard what's called quantitative easing 2, and in that they are looking at purchasing bonds, which will help drive rates down. However, we've had some other economic news that has started to drive rates back up. Right now, any good economic news, so if we start to get out of this recession and we really start to recover, more than likely that's going to be bad for rates. Not necessarily bad for homes, not necessarily bad for purchasing properties, because hopefully that means rising home values. But it could mean a little bit higher rates. I would say over the last week, we've seen rates go from about 4.25%, 4.375 to maybe 4.5. So not a huge jump. But right now, what we're watching is the trend. If the economy is turning around, we'll start to see rates trend back up.
So interest rates going up is actually a good thing, good sign for the economy overall. Just as mentioned, home prices going up as well. And you kind of think of, let's start with an interest rate increase of 4.25% to 4.5%. It's a pretty big difference on a home if you're looking at a $200,000 house.
It's not a huge difference in payment. Probably from 4.25% to 4.5%, maybe $30 a month.
Okay.
So not a huge difference.
And as you said, as rates go up, it's also because home prices are going up as well. And so as the prices go up, that also increases it. So it's kind of a catch-22. I mean, they're going up. It's not a big jump. It's not a big difference in the payment, but you do start losing your buying power real quickly. So that's something to keep in mind as the market recovers. It will happen pretty quickly. Let's see. Historically, rates are almost never been at 4%. Is that right?
Correct. Historically, rates, depending on how far back you want to go, I would say rates over the last decade or so have been really around the 6 to 7% mark. And then in 2008, they really started trending downwards. And then this year, they really got down into the low 4s, which is historical in its nature.
So definitely. I mean, so anybody that's looking at rates going up and starting to freak out a little bit, just realize that anything still at 6 or lower is still an amazing rate. And so these little changes we're seeing here now are fluctuations to the market, but not something that should cause you to buy a home too quickly. But definitely start thinking about it. Anything else to share with them?
The rate game is a tough one to play. I think, by and large, the long-term outlook for rates, probably for most of 2011, is still pretty good. And when I say that, probably in that 4.5%, maybe to the 5.25% trading range. But if you're in the short run, if you're trying to close in the next 2 weeks, 3 weeks, 4 weeks, you'll probably see some volatility in the market, just given the time of year and what's happening in the economy. So the rate game really plays into your time horizon on closing.
So if you're one of those buyers out there that are looking to buy a home, and you've got a home in mind, and you've got, let's say, 45 days to close, what's the best advice? Lock now or hold, or is it always just kind of risk versus reward?
My philosophy as a loan officer, and when I sit down and speak with people as a licensed mortgage professional, I tell everybody the same thing. If you're comfortable with the payment and comfortable with the rate, you lock and don't look back, because you can always second guess yourself in this business. I've owned a couple houses, and every time I've locked, it seemed rates went down. So it doesn't really matter who you are. To predict it is next to impossible. So if you're comfortable with it, lock and don't think about it again, and enjoy a cup of coffee instead.
I like that. Yeah, a lot of my buyers will sit there and worry about locking. Should I do it now? For 2 weeks, they'll start to stress out about it, and just kind of ruins life to a small degree. So I like the advice. Just lock it, get back on forward with life, and making sure that home is what you want, and get ready to move. So, excellent. Thank you. Well, thank you for joining us, everybody. We appreciate it. We'll be back next time.
Thank you. Have a great day.
See you.